We've seen profit jumps at quite a few of the big U.S. banks, posting better than expected earnings, boosted by investment banking and trading. Our guest says these increases in investment banking and deal making are nice. It's a comeback, but certain challenges across the banking sector remain. Let's get more from Octavio Marenzi, Chief Investment Officer at Opimas. Thank you very much for coming on the show.
Well, thank you very much for having me again.
Just remind us, or what themes have you seen? Is there one or two themes you've seen in this bank reporting season?
Well, I think there's two very clear trends. One is that, as you pointed out, investment banking did very well, and that was right across the different areas in investment banking: mergers and acquisitions, equities underwriting, as well as debt underwriting. And I think debt underwriting was a bit of a surprising one that we saw that pop this quarter, because I think a lot of corporations have been holding off issuing more debt because of high interest rates, and basically saying, okay, we're going to wait for interest rates to come down, we're going to wait for interest rates to come down, and they're not coming down. So finally they throw in the towel and say, okay, we have to bite the bullet and pay these elevated interest rates. So we saw a bit of a opening the floodgates there, where there was more debt issuance activity than we'd seen before. So that was encouraging. That might be a one-off kind of effect there. But equities doing better, mergers and acquisitions do better. And then on the trading side, equities trading doing particularly well. So we've seen a big increase in volume there. Equity levels are really high at the moment. We had a fantastic quarter, and that's translated into profits in the market-making activities and proprietary trading there as well. So that's really positive. Fixed income a bit less so. On the other side of the house is sort of the Main Street banking, sort of the retail banking and commercial banking side of things. And there things look a bit less impressive, in the sense that we've seen net interest margins steadily get eroded over the course of the past few quarters, and even at some banks over the course of the past year. So just a steady quarterly decline in terms of net interest margins, loans down ever so slightly, deposits down, everything sort of in single digits but pointing downwards. We've seen big increases in provisions for credit losses. So a lot of these banks are basically saying, we need to squirrel some money away because we're expecting to see a rough patch in terms of the US consumer and US corporates, particularly commercial real estate and areas of that sort. So we need to create better deposit base or provisions for loan losses, and they've built that up. So that's the basic story. Wall Street doing really well, and sort of Main Street less so.
Talk to us about Citigroup, because that company it's seen as having quite a bit of repair work and restructuring. Is there evidence that they're succeeding?
Well, I will say Citigroup's stock price, compared to the other players in this space, sort of the top 5 or 6 banks in the US, really lagged for a very, very long time, and it was sort of the poor step cousin in that group of large banks. Jane Fraser, the CEO, put into place a very large transformation program. I think it was in September or October of 2023, where basically said we're going to strip out all sorts of layers of management, we're going to rationalize the organizational structure, we're going to have a laser focus on expenses, and that's going to pay us enormous dividends. Now, the market has paid her, given almost a sort of unlimited credit in terms of that, and basically pushed her stock price up over 50% since then. And she's way outperformed the other banks in that sector. But that's all based on future promise, and it's all based on the future promise of this big transformation really taking hold and working out. I will say at this stage, and maybe it's still a bit early, but we are, coming up to not far away from 1 year into this restructuring program. It's hard to see the results yet. So if you look at the financials, if you look at the operating expenses, if you look at the revenues, if you look at any sort of metrics, it's hard to see that this transformation is really fundamentally transforming Citigroup at this stage. It remains to be seen if she can do it. Maybe she can. We need to give a full year, or maybe even 1.5 years. But I think the indication so far is that Wall Street might lose patience with this transformation program at Citigroup, and the stock price then might get punished in the future as a result of that.
If Jane Fraser can't deliver. You touched on this, evidence that Main Street business, regular lending, is beginning to sputter at some of the banks. Talk to us about Wells Fargo and Bank of America. Did we see that at those two lenders?
Well, we certainly saw it at Wells Fargo. So really, Wells Fargo is kind of interesting because it's you can see sort of single-digit declines in their retail banking business, in the commercial banking business. Asset management and wealth management did a bit better. But unlike some of the other big banks, Wells Fargo does not have a very big capital markets or investment banking organization. So they did not benefit as much as the other ones did from that upswing. So, JPMorgan and B of A and and Citigroup have very large trading houses, trading arms, and investment banking activities. Wells Fargo has some of that, but nowhere near as big, and so they're more exposed to sort of the Main Street banking. And there you can see basically steady declines, nothing alarming, but sort of just slightly modest declining, drifting downward, almost right across the board. Now, Wells Fargo stock did get slammed when they came out with their earnings announcement a few days ago, and it went down 6%. And it's recouped that. So Wall Street, I guess, has looked at that and said, okay, maybe we overreacted, maybe it's not that bad. But I think it was not a particularly spectacular, stellar set of earnings that Wells Fargo came out with. It was basically sort of declining, and I think there's a fear that that's going to carry on into the future. That Wells Fargo is on this kind of trajectory that's maybe difficult to get off once you started on it. That you're sort of in a vicious spiral downwards. So that's I think was bothering them there.
And then finally, JPMorgan, favorite with many investors, trading near record highs. Did they deliver once again?
They continue to impress. I don't know how Jamie Dimon does it, but quarter after quarter, year after year, somehow he gets it right. Now I don't know how that's possible, but he's consistently delivered very, very good results, and this quarter was no different. He was arms and away better than the other institutions out there. And that was true overall for the bank as a whole, but also in individual lines of business, you saw that quite clearly. So if you looked at JPMorgan's investment banking, fixed income trading for equities trading side of things, they clearly outperformed Goldman Sachs in that space, showing much, much greater growth than Goldman Sachs did in those key areas as well. So even up against the pure investment banks like Goldman Sachs and Morgan Stanley, JPMorgan did better there in the investment banking arena as well, but did very well in the other lines of business as well. So overall, very impressive institution and run very, very well.